Welcome back to the deep dive. Today, we are going to strip away the glossy surface of the stock market. You know, when we talk about finance, it's usually all about the trade, that split-second decision.
Right. Buy this, sell that, beat the market.
It's loud, it's fast, and honestly, it's very cinematic.
The Wolf of Wall Street version of finance.
Exactly. But we are going to ignore all of that today. We're looking at what happens after the trade, after the dust settles, and a company has to actually send money, we're talking billions of dollars, to millions of different people.
All with different tax codes, different bank accounts, and different sets of rules.
Yeah. We're looking at the plumbing of the global financial system.
And specifically, we're deep diving into the technical manuals for a software system called Temenos T24 and its corporate actions module.
Now, before you tune out because I said technical manuals, let me tell you why this matters. If this software messes up, you don't get your dividend. Your stock split doesn't happen. The market, well, it basically freezes.
That's a great way to put it. We're talking about the engine that turns a stock certificate from just a piece of paper into actual tangible value.
A corporate action is dynamic.
Exactly. Owning a stock is static. A corporate action is an event, a dividend, a merger, a rights issue. It's when the security actually does something.
And the T24 system is one of the main tools banks use to automate all that chaos.
So yeah, let's walk through it.
Okay, we've got a massive stack of these user guides here. They cover everything from Swift messaging to tax law. But it seems like every single event, every single one, starts with one specific record, the diary.
The diary. It sounds so quaint, doesn't it?
A little bit, yeah.
Like a personal journal or something. But in T24, the diary record is the absolute source of truth. It's the command center for any corporate event.
So if a huge company, say Apple, declares a dividend, that starts its life as a diary entry.
Precisely. The diary record holds the rules of engagement for that specific event. It stores the security ID, the rate, so how much they're paying, and three absolutely critical dates: the announcement date, the X date, and the pay date.
Let's pause on the X date because I feel like that is where a lot of people get tripped up.
It is the cutoff point.
Yeah.
The system has to draw a line in the sand.
So if you buy the stock.
If you buy the stock before the X date, you get the money. If you buy it on or after that date, you don't.
And if that date is wrong in the diary?
Millions of dollars go to the wrong people. It's that simple.
Now, the guide mentions that these diary records can be created manually. I'm just imagining a bank with millions of positions. Surely they aren't typing these in by hand?
You can. And sometimes for small, obscure private placements, they do. But the goal is always STP.
Straight through processing.
Exactly. For T24 is designed to ingest data feeds from providers. They send a signal, a message, and the diary just builds itself.
Okay, so the diary is the rule book. It says, Company X is paying 50 cents on this date. But that's just a general rule. How does that translate into my bank account?
That's step 2. Once the diary is authorized, once a human or a system gives it the stamp of approval, T24 triggers the entitlement process.
I love that word, entitlement. It sounds so distinct.
It's fitting, I think. The diary is the event.
Yeah.
The entitlement is the personal calculation. The system sweeps through the entire database of shareholders. It looks at every single client who held that stock on the record date.
And then?
Then it generates an individual entitlement record for each one.
So if a bank has, say, 50,000 customers holding that stock, T24 instantly generates 50,000 entitlement records.
In seconds. And it calculates the gross value.
Mm.
You hold 1,000 shares, the rate is 50 cents, your entitlement is $500.
But reading through the status codes and the documentation, it seems like it's rarely that simple. I saw INU and IHLD popping up a lot.
Ah, you're looking at the safety mechanisms. IAU stands for Input Authorized. That just means the system calculated it, and it's waiting for a final nod to post the money. But IHLD, Input Hold, that's the interesting one.
That's the red flag.
That's the red flag.
Right.
The system puts an entitlement on hold if something doesn't look right.
Like what?
Maybe the customer's account is frozen.
Yeah.
Maybe there's a tax discrepancy. Or, and this is a big one, maybe the event is optional and we're waiting for you to make a choice.
Right, and we'll definitely get to those choices. But first, I have to ask about the oops factor. What if the diary was just wrong? What if some intern entered a $5 dividend instead of 50 cents?
That is the nightmare scenario. But T24 has a reversal function built right into its core architecture. If you reverse the diary record, the source of truth, the system automatically cascades that reversal all the way down.
To all 50,000 entitlements.
To all of them. It pulls the money back.
It's a massive undo button.
It is. It's unwinding financial reality.
Yeah.
And you can just imagine the panic in the back office when that button has to be pressed.
So that's the happy path, cash in, cash out. But the documentation gets really complex when we move away from simple cash dividends.
Yes.
We enter the world of options.
Because cash isn't always king. Sometimes a company says, we aren't paying you money, we're giving you more stock.
Oh.
Or you can choose between money and stock.
And this is where that entitlement record has to get smart. It's not just a calculator anymore. It's what? A ballot box.
That is a great way to put it. The entitlement record presents the options that were defined back in the diary. Option 1,
Yeah.
cash. Option 2, scrip, which is just banking jargon for new shares.
I saw something in the UK section called enhanced scrip that sounded unnecessarily complicated.
Welcome to British finance. Enhanced scrip is fascinating. In that scenario, you might have 3 options.
3?
Yep. Standard cash, standard shares, and this is the kicker, shares that come with a bonus cash payment attached to them.
Why on earth would they do that?
It's usually for tax incentives, or they're just trying to encourage investors to keep their capital in the company. But for the software, it's a headache. T24 has to track the election for every single customer. If you have 1 million shares, you might say, I want 50% in option 1 and 50% in option 2.
The system can handle split decisions.
It has to. And it has to handle the default option if the customer is lazy and doesn't reply by the deadline.
Which brings us to a really messy mathematical problem I found in the notes, rounding. Because if I choose stock, the math almost never works out perfectly. If the share price is $100 and I'm owed $250, I can't buy 2.5 shares.
You cannot tear a stock certificate in half. This is where fractional chaos sets in. T24 has a specific field in the diary for rounding rules.
I saw the list. Down, UP, standard, and fraction.
They're pretty self-explanatory, but they are legally distinct. Down is the most common. You just truncate the decimal, you get 2 shares, the 0.5 is gone.
Wait, gone. I just lose that value.
If the rule is strictly round down, then yes. But that feels unfair.
Yeah.
So T24 has a feature called cash remain, or odd lot processing.
And with lots.
It's an old term. Basically, this system says, okay, you get 2 shares. That covers $200 of what we owe you. We have $50 left over. We'll pay you that $50 in cash.
So I get a mix. 2 shares and a check for the difference.
Exactly. It tidies up the messy reality of division. The software's whole job is to impose whole number logic on a decimal world.
Speaking of imposing logic, let's get to the most technical part of this deep dive. I read this section 3 times, and I think I finally get it. Equalization.
Ah, yes. Group 1 and Group 2 units. This usually applies to things like mutual funds or unit trusts.
It honestly felt like I was reading an inventory manual for a grocery store.
It's the same logic. It's inventory logic applied to money. Here's the problem. A mutual fund collects income from its investments all year long. It puts that income in a pot, let's just call it a soup pot. At the end of the year, it serves that soup to all the shareholders.
Simple enough.
But what if you bought into the fund yesterday?
I see. The pot is full of soup that was made before I even got there.
Exactly. If the fund serves you the full bowl of soup, strictly speaking, you haven't earned it. You just bought soup that was already in the pot.
So it's not a profit, it's a refund.
Bingo. It's a return of capital. And the taxman cares about this distinction deeply. Income is taxed one way. Return of capital is taxed completely differently. Usually it's not taxed at all because it's just your own money coming back to you.
So T24 has to track when I bought every single share to know if it's Group 1, I was there from the start, or Group 2, I arrived late.
Yes. And if you sell some shares, it has to decide which ones you sold. Did you sell the old ones or the new ones?
And that's where those acronyms came in. FIFO and LIFO.
First in, first out. FIFO, or last in, first out, LIFO. The diary has a setting for inventory method. If you set it to LIFO, the system assumes you sold your newest shares first. It runs this logic across millions of transactions instantly to put every cent of the payout into the correct tax bucket.
That's wild. It's calculating the genetic history of every single share in your account.
It's the only way to be tax compliant. It would be impossible to do that manually.
All right, we've covered the happy path, the options, the messy math. Now I want to look at the dark side, the edge cases, the stuff that feels risky. Let's talk about short positions.
The short seller.
Yeah.
Usually the villain of the market narrative.
Right, and for you listening, just to clarify, being short means I've borrowed a stock from someone, sold it, and I'm hoping to buy it back cheaper later. I don't actually own it.
Correct. You have a negative share balance.
So here's the puzzle. If Apple pays a dividend while I'm short, who gets the money? The person I borrowed it from thinks they still own it. The person I sold it to actually owns it. They both want the cash.
and the companies only get to pay once. So this is where T24 performs a magic trick called manufacturing the dividend.
Manufacturing it.
The system looks at your account on the record date, it sees your short, it generates a negative entitlement. A bill. Exactly. T24 automatically debits your account for the amount of the dividend. It takes that money and pays it to the person you borrowed the stock from. You, the short seller, are paying the dividend out of your own pocket.
That is incredible. The software enforces fairness. You can't just hide.
No. The system checks the soft delivery or SBL stock borrow lending modules. It knows exactly who owes what, and it makes sure the original owner, the lender, is made whole.
There was another edge case called rights issues. This felt different because it seemed like the system was creating a new asset out of thin air.
It effectively is. A rights issue is just a company saying, we need to raise money. Existing shareholders, you have the right to buy new stock at a discount.
Like a coupon.
A tradable coupon.
Yeah.
T24 treats these rights as a temporary security. They just appear in your account. You can hold them, you can exercise them, buy the stock, or you can sell the rights to someone else on the market.
But they expire.
Yes. And this is a huge operational risk for banks. If you do nothing, the rights lapse. They become worthless. T24 has a cleanup mechanism to sweep through accounts and delete these expired rights so they don't clutter up the books. It's a constant cycle of creation and destruction.
Okay, zooming out a bit. We've talked about all the calculations inside the box, but how does T24 talk to the outside world? I mean, banks don't just email spreadsheets to each other.
No, that would be a security nightmare. They speak SWIFT.
The global financial messaging system.
Correct. And for corporate actions, they use a specific category of messages, the 500 series.
I saw MT564 and MT565 all over the guides. They sound like droids from Star Wars.
They kind of function like them. The MT564 is the notification. It's the digital shout that says, hey, a dividend is coming. T24 is just listening for these messages. It parses them. It literally reads the text tags inside.
It reads the text.
It scans for keywords in specific fields, like tag 22F. If it sees bonuses, it knows to build a bonus issue diary. If it sees DRP, it knows it's a dividend reinvestment plan.
So that's the input. What about the output? When I decide I want cash instead of stock, how does the company find out?
T24 generates an MT565. That's the instruction message. But here's the really cool part. Aggregation.
It doesn't send one message for every customer.
It can't. The volume would crash the network.
Yeah.
So T24 just tallies up the votes. Okay, 500 customers want cash, 200 want stock. It creates one bulk MT565 message and fires it off to the custodian bank.
So it's a funnel. Thousands of individual desires all condensed into one digital instruction.
Efficient and anonymous. The company doesn't need to know who chose what, just the grand totals.
We have to talk about the one thing that connects everything we've discussed. Taxes. The guide had fields upon fields just dedicated to tax rates.
It is the heaviest part of the entire module. T24 has to distinguish between source tax and local tax.
What's the difference?
Source tax is withheld where the money is generated. So the U.S. government taking a cut of an Apple dividend. Local tax is based on where you live, say, France.
And I assume T24 has to know about all the tax treaties between countries.
It does. If France and the U.S. have a treaty that lowers the rate, T24 applies that specific rate to your calculation. It also has to handle things like tax credits.
I saw that. Gross versus net.
Yeah. In some countries, the corporation pays the tax for you, so you get a credit, so you don't have to pay it again. T24 tracks the gross amount, the pre-tax, and the net amount, what you actually get, to make sure your annual tax report is accurate.
It really highlights that this isn't just a calculator, it's a full-on accounting engine.
Double entry bookkeeping. Every single penny is tracked. In fact, T24 uses suspense accounts.
Suspense accounts? That sounds dramatic.
It's a holding pen. When T24 thinks a dividend should arrive, it doesn't just credit your account instantly. It puts the money in a suspense account, and it sits there waiting for the nostro reconciliation.
Which?
The bank's actual bank account. T24 waits for the signal that says, yes, the hard cash has physically landed in our vault. Only then does it move the money from suspense to the customer. It prevents the bank from paying out money it doesn't actually have yet.
It is checks and balances all the way down.
Yeah, absolutely has to be.
So when we step back and look at this entire system, the diary, the entitlements, the fractional rounding, the tax logic, the SWIFT messaging, what are we really looking at?
We're looking at a logic engine that's designed to handle what-ifs. The market is fluid. People buy, sell, borrow, lend. Tax laws change. T24 is the rigid framework that imposes order on all of that fluidity.
The guide does mention that manual intervention is still possible. You can go in and edit the diary. You can force an entitlement. But the whole industry is pushing for this STP, straight through processing, total automation.
That is the trend. Remove the human touch points to reduce error.
And that leads me to a thought I just can't shake. As these systems get better at the really complex stuff, like that equalization soup logic or multi-jurisdiction tax treaties without a human blinking, are we reaching a point where the financial market is a black box?
It's the trillion-dollar question. We've built reversal buttons because we know humans make mistakes. But if the machine is doing the input and the calculation, do we still need the reversal button? Or does the risk of a runaway algorithm become the new, bigger danger?
Right. If the diary feed is hacked or just glitchy, the system could incorrectly redistribute billions of dollars in seconds before anyone even notices.
And unwinding that, well, that is a deep dive for another day.
A scary but slightly thrilling thought. The market isn't just traders shouting on phones. It's this silent, invisible software running in a server room somewhere, just making sure the math adds up. Thanks for diving deep into the plumbing with us.
My pleasure.